Hi, welcome to another edition of Fleet Momentum video series produced by Automotive Fleet. I'm Fleet Group Associate Publisher Chris Brown. This episode is sponsored by and produced in partnership with Merchants Fleet. In this video, I connect with Brad Jacobs, Vice President of Strategic Solutions for Merchants Fleet. Brad and I discuss some important factors that will impact fleet budgets this year: high interest rates and falling residual values. Brad will offer strategies that fleets can use to mitigate both. Well, great. Here with Brad Jacobs, Vice President of Strategic Solutions for Merchants Fleet. Brad, welcome to Fleet Momentum video series.
Thanks, Chris. Happy to be here. Looking forward to our discussion today.
Sure. Well, let's get right into it and let's talk about a few things that are really kind of hitting fleets' pocketbooks here in 2024. After this supply chain disruption, we still have high interest rates. How can fleets look to mitigate interest rates, and what can they do to reduce that expense?
Sure. Yeah, I mean, the interest rate environment's been really challenging over the last 18 months or so. Obviously, the yield curve, it's still inverted. It can be very enticing right now to look at fixed rate lease structures, right, as favorable from a cost perspective. I think, one of the things that we're talking about with a number of folks in our portfolio is if you do go back in time and you look at history, float rate, it's always been the most cost effective, right, between fixed versus float, provided that the company is open to changes in what that payment's going to be month to month. So, a lot of people have forecasted the Fed to have, three downward adjustments by the end of 2024. You can, debate on the timing of that. But I think what is common and what is known is that with interest rates forecasted to go down over the next 12 months, 18 months, whatever that time horizon look like, it is seen as an opportunity to move from a fixed rate to a float rate because you don't want to lock in at the highest interest rate in history, right? Especially if all parties are pointing to, hey, it's going to go down at some point. So, there's nothing that anyone can do about interest rates, right? It's largely out of control, but what is in control is the choice between fixed and float and understanding where the market's predicted to go, deciding what structures to use accordingly. So when interest rates are high, like they are now, consider moving to future leases from fixed rate to floating rate leases and, save some money along the way, again, provided that there's an appetite for a little bit of payment volatility.
Yeah, that's a great targeted thing that fleets can do. Yeah, and that's a really great solution there, Brad. Okay, so part and parcel with that is residual values. We have seen residual values dropping, and heck, they're coming off of historic highs, but can you put some context around that?
Yeah. Well, depreciation is the number one or number two cost of operating a fleet, depending on where fuel prices are, right? So, as you pointed out, since COVID, it's been the most volatile resale market in history. And that it also includes the credit crisis that a number of us went through back in 2008, 2009, and so forth. So, back in early summer of last year, the market began to retract. It's continuing to normalize into 2024, into 2025. So, it's difficult to say how much further the market will normalize, but there's always ways to mitigate exposure to resale and those market fluctuations. Just a couple things that come to mind. One is closed-end leasing. It's a tried and true strategy, right? Swapping a payment for managing that depreciation on the asset. Those who are on shorter life cycles in terms of service, short-term leasing, rental, mobility solutions, those continue to be an option to remove any type of resale market volatility from the equation, particularly for those that work on contract work or have shorter life cycles, shorter terms. And many people believe as the resale market softens, it's best to hold vehicles, not replace them. We've seen that from time and time again. In fact, in many cases, the opposite's true because we're seeing the manufacturers become more aggressive with cap agreements, more aggressive with incentive monies. Not to mention the maintenance costs per service continue to rise with inflation. And then, as the vehicles get older, that vehicle has to get into the shop more and more often to be maintained. So in many cases holding, you're just switching money from one bucket, from a lease payment to another bucket, which is operating cost.
Mhm.
So, just being mindful of that. And with the OEMs coming back with incentives, they know that the buyers are starting to assume control. There's opportunity there from an order volume perspective to negotiate with CPAs.
Sure. Well, I mean, that kind of flows nicely into our next question on sort of broader strategies in remarketing to kind of manage that depreciation, manage that total cost of ownership. Any thoughts there?
Yeah, so just a couple.
Yeah.
Like tried and true strategies, right? Through like selling through upstream sale channels directly to drivers, specialty outlets. Those are continue to remain an effective way to get the most money out of vehicles through the disposal process. There are some solutions that will work for some that are a little bit more innovative, a little bit more out of the box in terms of getting higher returns and isolating fluctuations in the market. There's the example there is like guaranteed repurchase programs, right? Where the disposal of vehicles can be very quick. It allows a fleet manager to receive money within, a very short period of time, and then they remove any residual risk that they would have, whether it's an owned vehicle or an open-end lease, with a particular entity. So there are those programs out there that can be taken advantage of. Um, Secondarily, kind of going along with it, now more than ever, it's important to understand the equity position in vehicles, especially for any open-end lease structure where vehicles have been financed. The last thing anybody wants to do is take losses on sale, right? Incur high net depreciation when there's strategies, that can be put in place to receive gains on vehicles as well as losses. So, making sure that the right tools are in place to effectively manage the net depreciation on the asset is becoming a lot more important now than it was when the resale market was just going up and up and up through 21, 22, and the first part of 23.
Yeah, good question. Everyone looked like a hero back then, and it's a little bit more difficult to manage and really kind of rely on your FMC's partners, who are the experts here. Hey, I'm going to throw out a kind of a broad last question for you. Uh,
Sure.
what do you see as the biggest thing that most fleets are struggling to manage right now?
There's a couple. Inventory and order to delivery continue to be a focus, right? So particularly with some OEMs, especially if you have upfit applications. We're seeing budgeting and capital expense coming to the forefront as well.
Mhm.
And not from an organization perspective, the big question is, what's going to happen over the course of 24, 25 from an economy perspective?
Yeah.
Do I place that bet now to make additional investment into fleet as a cost center? Do I hold some of it back? So just having the right tools, having the right information that's meaningful, but also, the industry sources and data to do what's in the best interest of cost for the fleet today, has become a focus. So that's key. Any seasonality in business, there's a number of things that can be done around seasonality where maybe I don't have to have 100 vehicles in my fleet all the time when I only need 100 for 4 or 5 months out of the year. Like there's flexible solutions, there's flexible things that fleet managers can do to mitigate cost and still keep the assets out in the field, providing the application that they were intended to do. So that and just, wrap together, just mitigating any future economic uncertainty is the big focus right now. And, those that are willing to do that, they're realizing cost savings and they're doing some things that are out in the market that are pretty impactful right now.
Yeah, well, that's great. And certainly attacking utilization is something that we can all kind of wrap our heads around for sure. Hey, Brad, thank you for joining us on this edition of Fleet Momentum video series. Great education for our fleet viewership.
Thank you, Chris. Thanks for having me. It was a pleasure to talk to you today and looking forward to seeing you soon.
Sure thing.